I'm a big proponent of North American. There's a lot of companies out there that do IUL, NLG, F&G. They're all good companies. One of the reasons they kind of all have their own niches. One of the reasons I like North American, of course, it's an A+ rated company. It's actually an employee-owned company. And just like their term and all their products, everything comes with living benefits, of course, as most IULs do. But specifically within North Americans, IUL, their niche is they give a premium bonus, on top of the premium that you pay into it each month. So basically, you know, say you have an index and it's on a 1 year point to point index crediting strategy. And say your index goes up 8% 1 year. Well, years 1 through 10, you're going to get an additional 1.65%. It's usually around that. It can fluctuate a little bit, but it's generally about 1.65%. After year 10, for the rest of your life, well, as long as you own the policy, it's going to go up another percent. So hypothetically, after year 10, you're getting an additional 2.65%, say on top of a, hypothetical 8% index credit. All right. So that's their niche. Other companies have other little niches, little things that they do. But that's one of the reasons I like North American. So I'll just real quickly kind of show people how to set these up too. We got John Doe here, born in 1985, so that makes him 40 years of age. We're just going to do standard non-tobacco. North American also has three different types of IUL. There's the Builder Plus and the IUL 4. That's the latest version. There's also the Protection Builder, and then there's the Smart Builder. So just kind of the difference between the three. If you're talking to somebody and they want long-term cash value growth, like for retirement, things like that, you usually want to go with the Builder Plus. I will say it's a good idea to kind of, and you can do it real quick. Like I have the person's information in here right now. It's on the Builder Plus. So if I hit the agent only or the full illustration, it's going to show me the numbers based on that illustration. If you're talking to somebody and you want to see the other version, look at the Smart Builder. What the Smart Builder generally does is it's going to give you a little bit more cash value, more on the front end. But there's other factors that play into it too. It depends on how much money you're putting into it per month, what their, age is, rate classification, all those types of things. So I would just say generally, just kind of real quick, look at the difference between the two. So kind of told you a little bit about how Smart Builder is better, or how it's different, and the fact that it gives you a little bit more cash value on the front end. Now the Protection Builder is different. The Protection Builder is good because you can put a guarantee on it and guarantee it till 80, 90. You can guarantee it all the way up to 120. Now that is a rider. So generally speaking, like on my North American IUL, I don't believe in putting a guarantee on it, just because it's a charge, so any like cash value, it's not necessarily going to make your premium go up, but it is a rider and it's a charge, so it's going to take away from your cash value growth a little bit. But sometimes you're talking to somebody and you don't want to get into it too much, and if you're talking to an older person, they want to make sure that, hey, I want to make sure that this policy doesn't lapse out someday, so you can put the guarantee on it to make them feel all warm and cozy inside. I just tell people like we can do it if you want it. I don't do it, but and kind of the thinking behind that is the only reason you would ever need the guarantee is if the stock market, went negative for several years in a row and these indexes didn't perform like they always have, like over time. The stock market, I think when I looked it up recently, I don't think the stock market has ever had more than, it was either 3 or 4 consecutive years of negative growth. So just think about this for an IUL to lapse. Oh dang, I'm losing this. For an IUL to lapse, it would have to be negative several years in a row. We're thinking like 10 years, 15 years, 20 years. And the good thing about an IUL too is you're never going to get a negative index credit. That's one of the huge selling points of an IUL. Zero is your hero. So if if the S&P 500, was minus 5% this year, you're just going to get a zero. So you're not losing, you're never losing any of your account value. So that's huge. That's one of the big reasons it's, the selling point of why it would be better than say a regular 401k. Um, and then it's also tax free. So let me go back on the other page just while I'm talking here. If I can find that. Or I guess it doesn't matter. But oh, there it is. So yeah, so it's tax free. And that goes into the premise of, probably a lot of us have heard that saying, you want to tax the seed and not the harvest. So you want to tax the smaller amount and not tax the harvest. You want that tax-free retirement. Kind of like a Roth IRA. Sometimes you might get people to say, well, yeah, this sounds great and everything, but why don't I just do a Roth IRA and then maybe I won't have a cost of insurance involved, because, the premium that you're putting towards this, the vast majority of it, like 90 to 95% of your premium can be set up to where that's going towards your cash value growth, for your retirement or whatever. That other 5 to 10%, that other 5 to 10%, is going towards the cost of insurance. But what you can say to that, if somebody brings up the Roth IRA, where it is different from a Roth IRA, because they are both cash, or tax-free growth potential. A Roth IRA does not have that 0% floor. So on negative years, a Roth IRA can lose money. So that's the big difference, compared to a Roth IRA. Again, let me get into this. So, John Doe, we got it on Builder Plus, IUL 4, standard non-tobacco. When I'm doing this for somebody with cash value for the solve, there's as you see on here, there's a bunch of like drop downs and information you can put on. There's really only like 4 or 5 things you want to focus on. The rest of the stuff you can kind of just leave alone. But you want to do the solve for. When I do the solve for on one for cash value growth, you want to put it on specified no solve, because then you can kind of just put in your own numbers and play around with it. Now I put the initial death benefit at 100,000. The reason I put it at 100,000 is because you can actually go as low as 50,000. But North American gives a real good price break on 100,000. So I'll usually start at 100,000. Even for kids, a lot of times, usually I'll put it at 100,000 because the cost of insurance difference between 100,000 and 50,000 really isn't that much. And if you put it up to 100,000, it's going to increase that annual maximum amount of money that you can put into it, which is the 7-pay annual max that you'll see on here on the illustration in a second. So usually start that at 100,000. If somebody wanted a higher 7-pay annual maximum amount, the maximum amount of premium they can load into this per year, you can increase that by just increasing the death benefit. So you can kind of play around with it. You can put it up to 150, 200. And when you look at the illustration, you'll see that maximum amount increase. And the real quick, the reason you never want to go over that maximum amount is you don't want these to become a MEC, which is an acronym for Modified Endowment Contract. You don't want it to become a MEC, because once it becomes a MEC and you go over that annual amount, all of a sudden, this policy is going to become taxable. So, that's what we don't want to have happen, generally speaking. We don't want our retirement to be taxed, if at all possible, of course. All right, so the second thing you always want to put in here is the death benefit option. There's level, increasing, and in return of premium. Now, I used to always do it as increasing. What that does is it increases that MEC amount, when you're doing this. But actually, usually the better way to go is just to do the return of premium. What that does is it increases that MEC amount, so your death benefit will increase all the way up to age 65, and then it will start to level off after that. So it'll keep your costs of insurance low. So, and you can kind of play around with that too. But from all the trainings I've been on and, talking with my, the mentors at North American, generally return of premium is the way you want to go. And then in this one, the third thing I put in here, We're doing a specified premium type. So I put in $300 just to start off with. And I'd say generally speaking, if you're speaking to somebody who's 40 years of age, in the 40s, say like 40 to 50, if somebody's really trying to do this for retirement, I would just say, generally speaking, you want to try to get them to commit to at least like $300 a month to make these numbers impressive and really make this a worthwhile like retirement account. And, if you think about IUL, there's basically like two factors in this, right? It's all about the amount of money that you're putting into it per month and the age at which you start it, or the time, the total amount of time that you're going to be doing this policy. So if, say this person is in their 50s or 60s, if they want to do one of these later on in life, obviously based on actuary tables, say we're all going to die around 85, just to throw that out there. Obviously, somebody in their 50s or 60s is going to have a lot less time between now and 85, or even 65 when they start their retirement, versus somebody who starts in their 40s. So what an older person would have to do is the way to get around that is obviously you have to increase the premium. So, you'd probably want to start looking at amounts maybe like 400 or 500, the amount of money that you put in and that time factor is going to make a huge difference in the illustration, the numbers that you're about to see. All right. And after I put that information in, you want to hit calculate guidelines. The other thing I want to talk about real quick is the index allocations. Now, generally speaking, and this can change over time, but I know right now when you look at the index allocations, generally right now with North American, they're going 50-50. So 50% is going to go on the high participation fidelity index. That's being illustrated at 6.53%. This is the cool selling point of the fidelity one. So the participation rate on that is 245%, and it's uncapped. See this cap rate right here? There's no cap rate like the S&P. The most you can get from the S&P is 10.5% because that's the cap. This fidelity one does not have a cap. So it's kind of like, when I was talking to my North American mentor, this is kind of like your home run index. And then the reason you want to put your other 50% in this S&P 500 is this one is more of like a consistent index, so the way he explained it, this would be, the other one's the home run. This would be more like your singles and walks and doubles, So, if we go, I'll go into the illustration here real quick. Let's see. Okay, so just to go down to it real quick, and I'll jump around here. If we go down to those index percentages, so they're both illustrating about 6.5%. But if we go down here, okay, so they just happen to be the first two. Like here's the high par one, the second one in. Over the last 20 years, even though we're only illustrating it at about 6.5%, over the last 20 years, it's actually performed at 11.4%. All right. The S&P 500 is better than the 6.5% approximately that we're illustrating. Over the last 20 years, it's at 7.4%. So that's another thing, you always want to under promise and over deliver, so to speak. So, I mean, even though we're only illustrating this, that you'll see in a second, at about 6.5%, it might be like 6.58, I think. These have proven over the last 20 years, these are actually performing at far higher than that amount. So, you can kind of throw little tidbits out there to the client, like, hey, even though it's performing at this, I mean, look at the performance of the last 20 years. We can't predict the future, but there's also a very good chance that this could do even better than what this illustration is showing. And if you look at year by year, the high par fidelity, yeah, there's going to be some years where you have some zeros, but look at this is a grand slam right here. Look at 2019. I mean, I'd be doing backflips if my IUL got an index credit of 29%. Plus, after year 10, another 2.65% on top of that. That's putting you at like 32%, something like that. And then if you look at the S&P 500, The S&P 500, not only does it have a cap rate, but it looks like it has a guaranteed floor of 0.3%. So on the S&P 500, I mean, look at all these consistent 10.5%, it's like almost every single year. And even on the terrible years, you know, 0.3, I mean, it's not great, but it's better than zero. You know, if I had you know, my money in my 401k and I just lost, you know, 40% back in 2008, 2009 during the housing crisis, and I got to work another 10 years to make up for it or whatever, I'd much rather have a 0.3% gain than losing 40% of my portfolio, obviously. So I'll get into the illustration here in a second, but I just kind of want to run through this real quick, just the main illustration. So of course, you know, one of the things that this, like I said, that this comes with is the living benefits. So it's going to have your, you know, your general terminal illness, chronic illness, and critical illness. I think most of us know generally what those are. You know, I always tell people like, hey, you know, obviously we might be good right now. We're younger, we feel healthy, we feel good, but gosh, I mean, I don't know what the exact percentages are, but I feel like one of these things at some point in our life is going to happen to probably like 75% of us. I mean, look at, you know, for instance, like, you know, the president, yes, your former president, you know, Joe Biden, he got diagnosed with you know, metastasized late stage cancer yesterday, you know. If, you know, somebody like that had this policy, you know, that falls into the critical illness. So if he had a policy like this, he could get paid from this. So just think of all the things that happen to people later on in life, you know. I mean, cancer's everywhere. You know, this is gonna cover things like, you know, heart attacks, kidney failure, major organ transplant, or just say we're really healthy and we get old, you know, and we're 90 years old and all of a sudden like our legs, you know, might not start working like they used to, and we're in a wheelchair. We have to, you know, hire some home health care to like help us go to the bathroom or something like that. You know, that falls into the chronic illness. So, you know, that's the thing is like, you know, when we have to hire these people, you know, home health care services, or, you know, maybe we can't, maybe we were planning on working really late into life. You know, I know me, I feel like I'm never going to retire. All of a sudden you can't work, you know, this is going to help pay for those services. This is going to help replace that income. So it's a very valuable benefit, I feel like, for most people at some point in their life. Um, so I'll just kind of, you know, we've went over the living benefits a little bit. This is just some of the guarantees. You can kind of read through all this. I'm just going to get to the meat and potatoes of this real quick and show people the numbers. Okay. So like I said, $300 a month. His death benefit is 100,000, like you saw in the setup process there. Um, Actually, let me get off this one because this doesn't show some of the numbers. Let me get the agent only one. I like the agent only not one sometimes because it shows like some different things. So what it's going to show on the agent only versus the full illustration is it shows these numbers up here. So like the 7-pay annual, like I said, so he's putting in $300 a month, which annually that comes out to $3,600. But you know, basically he can put in up to $7,000 per year before this becomes a mech. And over time, depending on how the indexes perform and all these other factors, this 7-pay annual can change. So like on my IUL, I put $600 a month into mine. Last year when I was approaching my policy anniversary date, so every year you have a policy anniversary date, you know, so you have that 12-month period that correlates with this 7-pay annual. So I was coming up on my anniversary date, and I actually called in a North American just to get a you know, an exact amount, and they told me how much more money I could put into mine for that year, you know, before it become a mech. Another good thing too is they have protection with that, and the fact that like if you ever made a payment without calling them or whatever, they have you know, this protection in place to where if you overpaid and it was looking like it was going to become a mech, they would actually reject your payment and send it back to you. So you can be pretty self-assured that, hey, this is not going to become a mech. I don't have to like, follow it to a T. They're kind of like watching your back for you as well. So let's look at like the 10-year mark, just paying the $300 a month. Again, this is a 40-year-old male standard, if this was preferred plus or he was younger, or if he was female, these numbers would look even better, because lower cost of insurance. So after 10 years, he's paid $36,000 into it. Again, this is illustrated at 6.58%. If you think back, that Fidelity, the 20-year historical performance was over 11%. So, this is a pretty conservatively projected IUL. But if we put in 36,000, after 10 years, that death benefit's gone from 100,000 up to 136,000, and then he has about $38,000 in cash value that he could borrow from. And that's the thing. When you take your money out of here, you never want to take it as a withdrawal. And definitely not in the first 10 years because there is going to be surrender charges. And that's what, when you get on the internet or if you Googled stuff, that's going to be, the big thing you hear about these from people that don't know what they're talking about, on the internet or wherever. They're gonna be saying like, oh, IULs are bad because they have like all these charges and fees. Well, first of all, it is a life insurance policy. It's a permanent life insurance policy. So your heirs are going to get this death benefit one. So that's a great thing right there. Number two, there is a cost of insurance. So again, you want to minimize that cost of insurance. I think mine is down to where my cost of insurance is like I put $600 a month into my IUL. And I think it comes out to about 5% of my premium is actually going towards my fees, because when I look each month, when I make that $600 payment, $570 is actually going towards my indexes, and then only 30% is going towards my death benefit. So, I'm keeping it as minimal as possible. So, and if you do it right, yeah, the fees are very minimal. That's why you want to take it out as a loan and not a withdrawal. So, like I said, most of these people that are kind of talking bad about IUL, they really don't know what they're talking about. That's why you don't want to take it as a withdrawal. You want to avoid those surrender charges. If you do this right, these fees are very minimal. And again, that's why you always want to take it out as a loan. Like recently, I wanted to kind of take advantage of this dip in the stock market that happened like a month, 6 weeks ago. So I took an $8,000 loan out of my IUL because I've only had it for a couple years, so I don't have like a ton of cash value in there. But I had like about $8,000 available. I took an $8,000 loan out. I bought the dip. The stocks have shot up in the last month. I've already made like a free like $3,000 on my $8,000 investment, so I turned my $8,000 basically into like $11,000 now, and it's going to go up even more, I'm sure, because the market was over 44,000, I think even 45,000 for the Dow. And right now I think it's hovering around like 42,000. So I know eventually, I mean, I don't know if it's going to be a month or a year or what, but eventually the stock market always goes up. And that's kind of how you have to think about it. Um, so yeah, after 10 years, you'd have the, $38,000 available, but look how it ramps up over time. And again, remember the other thing that premium bonus that you get the first 10 years, which is around 1.65%, these illustrations, not only are these very conservatively estimated at 6.58%, but these illustrations don't even show with that premium bonus. So, these numbers hypothetically would be even, could be very well be even higher with that premium bonus. And then remember, once we get here to year 11 and on, that premium bonus is going to jump up to about 2.65%. It just automatically jumps up another percentage point. So if we look down like year 20, now we've put in 72,000. Our death benefit has shot up to 172,000, and now we have over $110,000 of account value that we can access through loans. And say let's just say hypothetically we retire at age 70, 30 years into the policy. Um, dismiss that. So now if you look at the 30-year mark, we've paid $108,000 into it. The policy, the death benefit, if we died right now, our heirs would get almost $300,000, and we have $252,000 available for our retirement. Um, and yeah, basically you could call in, fill out a form, and you can start getting these periodic loans. Basically they just drop, if you set it up this way, drop, monthly a certain amount of money into your account that you request, to help with your retirement. Um, and I mean, let's just jump all the way forward here. Say we lived to age 90, we paid $180,000 into it. Um, we have over $1 million available, for cash value, if we hadn't taken any out to that point. And then of course it would pay over $1 million to our heirs, one or the other. You're not gonna get both of these amounts. It's just saying that there's if you wanted to, I don't know who would do this, but say you were 90 and you're like, oh, I want to buy like my son a house, before I die or whatever, pull $500,000 out of this and, buy him a house. Now he's not paying these like astronomically high mortgage rates. Oh, and that's the other thing too. And this is one of the biggest concepts about IUL that I will relay. And it's a little bit hard to like wrap your brain around at first, but the other cool thing is whenever you take a loan out from these IULs, you have the possibility of positive arbitrage. And let me go up. Let me see if oh, that was the good thing about the other version. It has the loan rates on there. So generally speaking, there's three loans. One of them is a variable loan. One of them is a fixed participating, and one of them is a standard loan. So I think right now the standard loan rate is about 2.75%. The fixed participating is probably around like 6.5%, just guessing. And then the variable is uh I don't know, probably like 6.75%, something like that. I actually think they're lower than that. I think they're in the fives. But anyways, when I took my loan out about a month ago, I chose the fixed participating. And somebody might ask, like, okay, you just said the fixed participating is, say it's at 5.75%. Um, and so the reason you would take the reason you would take a loan out with the higher amount versus like the fixed rate of 2.75% is when you do the fixed participating or the variable, you have that chance of positive arbitrage. So, obviously my loan amount is a much smaller amount. I said I only took out $8,000, but let's just say, let's go back to something more accurate. Say, this person works all the way till age 70. There's $252,000 available in here for loans or retirement income. They start taking this out, right? Say they take out $10,000 all at one time, just hypothetical number. They take out $10,000, with a fixed participating amount, which has the chance at positive arbitrage. That fixed participating, say you take it out and it's at 5.75%, right? Um, that next year, you get a index credit of say 10%. Well, basically how that would look is you're getting a 10% index credit on this entire 252,000 as if you never even touched it, right? Now the $10,000 that you pulled out, it will get charged that fixed participating rate of, just say hypothetically it's at 5.75% right now or around there. So you will get a charge on that 5.75%. But if you think about just that small $10,000 amount that you took out, which hypothetically is still part of this 252,000 because you're still getting that 10% index credit on this entire 252,000. So the $10,000 or the 10% gain versus the 5.75% charge for your loan, it's it's knocking it out. It's not a charge anymore. You're actually getting, you're making, just over 4%. You're getting a 4% index credit on a loan that you took out versus if you take a loan out for a car, house, um, anything else, you're paying astronomically more money. Like I know we've all bought a car before. You think about that long yellow piece of paper. Say you pay $30,000 or in today's day and age, 40, 50, 60, 70 and up for a car. When you look at that end amount of what you actually pay after you pay your financing, it's drastically more. Like I think the last car that I bought was like 2, 3 years ago, and it was my numbers might be off a little bit, but I paid about $30,000 for the car. But once I do the financing, I look at the end of the contract and I end up paying, say, maybe $38,000, maybe even more than that when it's all said and done. So it's kind of goes into that whole idea of infinite banking. Usually when you talk about infinite banking, we're talking more for whole life, because you're getting those almost guaranteed like um, not index credits, but they're dividends each year. But this is basically like the same premise. It's not a guaranteed dividend. The indexes are going to fluctuate, on a year-to-year basis. But I know, hopefully, I explained that aspect of it correctly. It's a little, once you hear it a few times and you understand how it works, it's a little bit easier to grasp. But so let's remember these numbers, okay? So, because I'm going to show you how much better this can be. Like if we double that 300,000 or that $300 a month, if we double that to say $600 a month, it actually doesn't double all these numbers. You'll see how it will actually go up more than double. So the more money you put into it, it's almost going to grow, slightly exponentially, is what I'm trying to say. So let's look at like the 30-year mark on the next one, when we put in the $600. So let's remember, like, let me just write this down. If we paid 108,000, $300 a month, and then our account value that's available is like 252K, and our death benefit would be 292K. So dang, they logged me out. Oh well, get back in here. All right, so I'm just going to change that real quick to 600 and we'll see what that difference is. And then we're almost done here, but what I'll do at the end is I'll kind of just open it up if anybody has any questions or anything like that. I was definitely talking a little bit faster this time. I'm trying to not make it go so long. So far, so good. All right, so here's John Doe again. All we're gonna do is change this from 300 to 600. All right, we're gonna hit calculate and then open up the agent only version. You just want to see the numbers. Premiums were reduced. Okay, we don't want to reduce the premiums. So in that case, I might have to just bump the death benefit up a little bit. Because it's probably gonna mess. You'll see in the premium column, it's gonna like mess with the numbers a little bit. It won't be a smooth like $600 a month in the premium column. So there's a way around everything. Let's see if this will ever come up here. This thing is doing, just gave me like 3 windows. All right, whenever we're ready here, or whenever you're ready, I should say. Come on, man. Get that off here. So is this it? Oh yeah, so see what it did here? The $600 a month times 12 is going to be the 7,200. So because it's trying to make sure that it doesn't become a mech, so it's starting to play around the numbers. It's saying like year 5, like only put in like 5,500. So all we got to do with that to fix that is I can just bump the death benefit up a little bit. Like let's say let's say I bump this up to 120,000. Let's see if that fixes the problem. I'm still trying to keep that death benefit as low as possible. So I could just bump it up to like 150,000, but I want to try to still keep it as low as possible. So it looks like it's going through at 120,000. I'm going to click the agent only again. And then it should just be a nice, smooth, same number all the way through when we look at it this time. Yeah, so see now it's 7,200 every year. So now your 7 pay annual is bumped up to 8,400. So because it went from around 7,000 up to 8,400, it's giving you a little bit more room, so it's not going to mess with the premiums and all that. So let's jump to year 30 again. So, this time we're doubling our premium. So we have, 216,000 is twice as much premium as a $300 a month version. Now, if you look over here at age 70, 30 years into the policy, now we have 544,000 of account value available for retirement or loans or however you want to use it, versus on the other one we had 252,000. So, doubling the 252,000 that would put us at about 504,000. So as you can see, doubling the premium isn't giving us the 504,000. It's just actually giving us another $40,000 in account value. And then instead of on the other one, the death benefit was 292,000. Here it's 631,000. So, you can see it's increasing more than just doubling. So, and then of course, where it gets real exciting, if you talk to some higher earners, and they're talking about, throwing $800 a month or $1,000 a month into here. I mean, these numbers are just, going to skyrocket even more. So, trying to think if I've covered everything. I mean, I think that's the gist of it. Hopefully, I explained that clear enough for everyone. If anybody has any questions or anything, go ahead and fire away.
So Joyce asks, so if you stay within the amount that shows you're not taxed on the gains when you pull out any money, am I understanding that correctly? Can you talk about how it becomes tax-free retirement?
Yeah. Anytime you take a loan out of here, as long as it's never become a mech through the life of the policy, it's always going to be tax free. So for instance, like I took that loan out that I was talking about. I took like that $8,000 loan out to, buy stocks. I mean, I could have made a down payment on a car. I could have had a party with it. I could do whatever I want with it. But that $8,000, because it's coming from a life insurance policy, and it hasn't become a MEC, a modified endowment contract, the government can't touch it. It's not taxable income. So hopefully, I'm looking on there. How do you know when it's best to do an IUL versus a term plan, for example, or an annuity? Um, that is I mean, that's a pretty complex question there. I mean, there's so many different ways you can go with that. I just think, really you need to like drill down on the needs. Like on my script, I really try to hammer them, towards the front of the call on what their need is, what they're really trying to do. I mean, if somebody was younger and they just have a bunch of young kids and a mortgage, the first thing I'm thinking right away is a term policy. That's your, cheapest way to get a high amount of death benefit. And yeah, if you have a young kid, think about if you have a 2-year-old, they still have another maybe 20 years or so before they're going to be financially on their own, able to take care of themselves. Where I'm going to do like an IUL for long-term growth potential is, if somebody's telling me, like if somebody said they were self-employed, like all of us, they're 1099, maybe ask them like, hey, do you have a 401k? If they don't, ask them, are you saving for retirement or anything like that? I mean, that would be a great prospect right there. Maybe just throw out a question like, hey, if I could show you a way to save for retirement and never get taxed on it and never have to take any losses from the market like you would in a 401k or even a Roth, would that be something that might interest you? I mean, that's a great prospect right there. So it just really comes down to the need and the conversation that you're having with the person, I think.
Yeah, I really like that question, man. It reminded me of what we were talking about earlier last week. Is when we first got in the business, everybody was pushing return of premium terms, right? And now I feel like those clients that we were putting into a return of premium term product, we probably should have put them into an IUL, you know? Um, Gathright, I think also people with lump sums of money, in my opinion, going an annuity versus an
Yeah,
IUL would be better. It generally always illustrates out better because
that's and just to add on to that, what I tell people too is like an IUL and like a single premium annuity, especially like they work very similarly. They generally both have like the zero floors. They're indexed. That's how you're getting your gains. Where they're different is like I say the biggest difference is an IUL is more like an accumulation vehicle. An annuity is more if you already have that money accumulated. That's the biggest difference between them. How I look. And then the other thing you got to realize is taxes too. Like an IUL, if you stay within the MEC limits, the cash value growth is never going to be taxed. Whereas an annuity, you kind of need to know all the ins and outs of like the tax rules and stuff, because generally, like any gains that you get from an annuity are going to be taxed. Like if you are contributing with non-qualified money, which how I remember that, I have this mind block on that at first, but non-qualified to me means it's just like not qualified to be taxed, right? So say you had $100,000 sitting in an account and you wanted to do an annuity, you're going to throw that into an annuity. That initial $100,000 is not going to be taxable because it's your net money. It's already been taxed at some point, generally speaking. Um, but any gains you get off that 100,000, say that $100,000 in an annuity turned into $200,000 or a million or whatever, that excess amount that you gain from it is going to be taxable. So,
and I really do like that question too, because in my opinion, I feel like when we're working with leads, it's kind of a scoop of America, right? We're talking to people in all different kind of scenarios. And as we're going through our discovery and we're finding out maybe they're young and healthy but barely getting by, I think that person we should put into a low cost simplified issue term maybe, right? And now their income, now the next person is they're young, healthy, making a little bit better money, able to put a little bit more money into a policy, but maybe not something where you want to go fully underwritten or something. You could look at maybe that IUL through Americo, the IULE through Moo, and now that same scenario, except now they're making good money. Man, North American is a great product for them.
yeah, another question I see on here is from Zach. It says, do you ever put 100% fund participating allocation towards the Fidelity high par? And I would say to that, like, yeah, you could if maybe you wanted to be a little bit more aggressive. And the cool thing about this too is like it's not set in stone. Like you can change these indexes whenever you want. So say you started off the IUL and you wanted to be, you know, real aggressive at first. And it's aggressive is kind of a relative word because you never have any risk of loss with these. So it's not like you're really being that aggressive, so to speak. But if you wanted to get the chance at those bigger gains, yeah, you could put 100% towards the Fidelity high par and then just monitor it. They're going to send you an annual statement every year. You can also log in and you can see, every, depending on when you made your payment, sometimes you're going to be getting these index credits, because it's a 1 year point to point. So they kind of all roll in, a year later from the time that you made that initial payment. So, most of the time, hypothetically, if you're paying monthly, you're going to be getting another index credit like every month. At least a year after when you start the policy, they'll just all start rolling in every month. So you can kind of monitor it, be like, okay, yeah, like this is going really well. I'm getting these big gains, but then say the market isn't so good 1 year. and all of a sudden you're getting like, oh, I got a couple zeros or whatever, you could go in and change it, and do 50/50 like that. Or you can have as many indexes as you want. You just fill out a form and send it back in. And the reason why I like the high par and the S&P 500 is not only is the system, I mean, the system is generally trying to set people up for success. They want these to look as good as possible. So the fact that the system is setting it up 50/50 between those two gives me a lot of peace of mind. Plus, also, if you talk to one of these regional sales directors for North American, which our guy, his name is Anthony Holen, or yeah, Anthony Holen. So I have his number if anyone needs. If you ever have any specific questions that maybe I can't answer, or Steven can answer, or somebody else, you can always call Anthony. He obviously works directly for North American, but I ask them what they do for theirs, and not only is mine set up this way, with the 50/50 strategy, but even the guys that work for North American, that's how they set theirs up too. As of for right now. Like I said, things change over time. So, just to reinforce, they're not set in stone. You can, down the road, if things change, you can change them however you want. So,
Can you talk about how the carriers calculate the commission? That's off the target, right?
yeah, so basically the target it's generally gonna correlate more with like the cost of insurance. Just like if we sell a term or a final expense policy, we're getting paid off like the actual cost of insurance. Um, with IULs, it's more the target, which is it's basically the cost of insurance is kind of intertwined into there. So all you want to do, it'll show it on um the agent only version. So let me get to that amount if I can find it again. I might have closed it out. Let me just pull it up again. So like this $300 a month version, if you go up to the top, so it's a $3,600 annual premium. So on a normal policy, you'd be like, oh, my AP is 3,600. I'm going to get paid off that. Well, with this one, because you're setting it up more for cash value benefit, the target on this is actually $2,044. So it's going to be lower than what the actual AP is. But it's like, if you're an ethical agent and you're doing the right thing for the client, I mean, I'm one of these agents, and it's a little bit easier if you're doing AK financial and you don't have that commission breath, so to speak, if you're not thinking about like, oh, the last thing you want to be doing is like while you're sitting there talking to a client, like, oh, how much money am I going to be making off this? I always try to like put that information out of my mind and just try to do the right thing for the client. And especially, and that's another thing, like where, IULs the last few years, why there is some negative information out there about them. It's not only like some people focus on the fees, which again, if you do it right, the fees are actually very low. There's a good way to do things and a bad way to do things. And the other side of that coin is, doing it the bad way. Also, when you set them up as an agent, you don't want to set this up where your target is like as high as possible. You want to be focused on how this is gonna perform for the client, of course. So let me show you something real quick. So remember this target right now is at 2044. So if I changed like so let me change it back to 100,000. So we're comparing it to the one I just did and $300. So if I change say I changed the death benefit option to level, it's going to make the performance not as good for the client as far as account value, that long-term cash value growth. But you're going to see your commission would go up because it's going to raise the target just by putting it to level. So actually I did something wrong here because it's still the same. Let me see, let me change something here.
And as you do that, there are a lot of agents in the industry that will set these up so that they can get paid more commission. And I think that's one reason that some people have bad taste in their mouth about the IUL.
I mean, the other good thing to do though is like I've spent so many hours going in here and like setting up illustrations and stuff. You really want to get in here and just play around with all these things. And there's webinars for all these IUL companies. Like I get emails for North American webinars all the time. Every time I get on there, even though I think have a lot of knowledge when it comes to IULs, it seems like every time I get on one of these illustrate or one of these webinars, I still learn like one or two new things. Um, so it's just like dive into it. Just try to like soak up as much information as you can. Because really like, you know, you don't want to like make it too complex for the client. You want to kind of give them a limited amount of information so you don't confuse the heck out of them. But I mean, so here's an example right here. I mean, I just changed it to I changed like the strategy and stuff. I mean, look, they're still putting $300 a month into it. So if I wanted to be a dirtbag, um, now my target, what I'm going to get paid on, went from 2,000 up to almost 3,500. So I'm going to get paid a lot more. But then like look down here at the numbers. Let's look at like that 30-year mark. Well, now you're looking like if the market plummeted and um, Armageddon happened and, all that bad stuff, the things that have never happened before. In these first two columns, which is like the guaranteed amounts, which, if the market went negative for, say, the next 20 or 30 years, this is what would happen. It would potentially lapse out. If it stays around 6.58%, which historically it's always been more than that, we'd be fine. But even if you look at this amount after 30 years, I think we were at 107. Yeah, it just messes it all up. Like, look, the death benefit isn't going up throughout the life of the policy. It actually starts at 170, and then when they might actually be more likely to die, like around 80, it's going to like 240. I don't know. It just messes with all the numbers. As you see in here in the middle, I mean, it's kind of going down and then it spikes back up towards the end of their life. But if they died at like 60, it's only paying out $52,000. But yeah, just generally, I would just say, play around with the numbers and just always like try to do the right thing for the client, put the commission like out of your head. So I don't know. Is there any other questions? Oh, how does the commission pay out? I hear about Target. How does it work if you take a loan and do the lower interest? Yeah, so if you do that 2.75% fixed rate loan, like if I did the 2.75% on the $8,000 that I took out or any amount, you just don't have that chance at positive arbitrage, So it would be a guaranteed like, you know, it's going to be a charge. You're not going to have a chance to actually like make money off that loan amount with the positive arbitrage. That's the difference. So yeah, you gotta do the two higher versions to have the positive arbitrage, which again is the variable and the fixed participating. So all right. I think there's one new one down here. When you have the death benefit where it's level, increasing, or return of premium, does the client beneficiary get the premium paid in back and the death benefit at the same time?
Yeah, so what I mean is when you showed like the level increasing or return premium death benefit part,
Uh-huh.
does like when the client passes away, does the like whatever they paid in, like the 300 per month, whatever they paid in, like say they passed away year 10,
Uh-huh.
do they get the 10 years of premiums back plus the death benefit to the beneficiary or
No,
just the
like
premium?
the return of premium is kind of misleading. It's more just
Oh, okay.
I mean, hypothetically, the good thing about these, man, is whatever you put into them, if they're
Yeah.
set up right and the economy does what it's going to do, like you're always going to get more back out of it, like no matter what, than what you put into it, either through the loans that you take out or the death benefit that's paid out, versus like a term policy. Like if you pay all this money into it, so if I paid, say I paid $36,000 into a term policy over the life of the term, and then I don't die within the term, I'm just out that money. Like that's almost never going to happen with an IUL if it's set up right. You're always going to get more back than what you put into it. It's like you almost like can't lose from it. Um, so yeah, the return, I think with some other carriers, they don't even call it return of premium, but it's the same concept. It's called something else. But yeah, I mean, it's not technically like, but also there is a return of premium option on here. Like when you do the protection builder, there's a couple different drop downs on there when you do the protection builder, but like you can guarantee the death benefit, but then there's also the premium endorsement rider, the PRE, where kind of like the return of premiums term used to work. You'll see when you look on the illustrations to where at the 15, 20-year and 25-year mark, they have this set like guaranteed amount that you're guaranteed to get back. That if somebody wanted to, and I don't know why anyone would ever do this, but say you got to the 15-year mark and you didn't want to do the policy anymore, you're guaranteed to actually pull, you could relinquish the policy or surrender the policy and get that amount of money out guaranteed, even if the stock market, plummeted for the next 15 years. But like I said, like I I would hesitate to even talk about, you kind of just I don't bring up the fact that like these policies could potentially lapse because like I said, we've never been in a economic situation ever before to where the stock market has been bad enough to where these policies would lapse. Because if you think about it, like even if you went back to like the worst market times, the worst economic times of our existence, you'd go back obviously to like the Great Depression. And I think, 1928 or whatever year it was, the stock market plummeted like I don't remember what it was. I was just looking at some of that information recently. Actually, let me pull it up if I can find it because I had a screenshot of it that was actually pretty cool because I was looking at like how many years the stock market has actually went negative because I always talk about that. Let's see, where is it? I think it's in my gallery here. I'm just looking for it. Ah, no, that's not right. Well, anyways, if you go back to that time frame, the Great Depression, um, you know, can't remember exactly. The stock market plummeted 50% or 70% or 80% or whatever it was, which if you had that money in a 401k or a Roth, you're literally if the stock market plummeted 80% and you had $1 million in your account, you just lost like $800,000. Like that would be devastating. Well, the good thing about this IUL is like you just wouldn't get a gain. You're not going to lose anything. You're just going to get that zero for the year. But on the flip side of that, I would say these financial crises, if you had an IUL, all these big financial crises, like even if you look back at the well, let's stay on track with the with with the Great Depression. I think during the Great Depression, there was either like maybe 2, maybe 3 years of loss where the market went down. But people always talk about like if you look right afterwards, I think the stock market went up like 50%, 60%, like the 2 or 3 years after. So actually, for like if you had an IUL and another Great Depression like scenario happened, it would actually be very good for us because we'd get zeros when the market plummeted, and then when it went back up, as long as you had like that uncapped fidelity index, all of a sudden we're getting like a 50% or a 60% gain. So yeah, I don't know if we all want to like cross our fingers and hope for, if you get an IUL, hope for another Great Depression. But if you think about it logically, it'd actually be like a very good thing for us. So
Right? You can pull an interest-free loan, buy a bunch of stocks really low, and double it up that way too. Hey Nate, Mikey did a really good job the other month using a North American IUL to get an older person extended death benefit. I know you've been on here for a little bit, but can you talk about why we did that and how we set it up?
Yeah, if I remember right, what we did is, there is a little bit more legwork to this. So there's two different ways we can do this. What I like is when you talk to somebody who's older, and they want that guaranteed death benefit. Um, what I've done in the past, if you don't want to go down this long road of, doing an exam, and because if they're 60 or over, with North America, they're gonna have to do an exam. They're not gonna have a chance at that accelerated underwriting. What I mean by accelerated underwriting is these are fully underwritten products. With the really healthy young people younger than 60, there's a chance that once you submit the contract, like I had God, how old was she? I think she's in her 40s. It was actually the wife of one of my friends from college. I did a $1 million term policy through North American. So she actually qualified for the accelerated underwriting, and within 24 hours, her policy was just approved and issued, super preferred. They didn't have to do an exam or anything. On the flip side of this, if you are talking to one of these people and they're over 60, they're going to have to do an exam. So as I said, it is a little bit more legwork, but if they're willing to do that, and I usually don't even word it as an exam. I'll usually just say like, hey Jackie, if we could get you something a lot better than what you have right now, or really or even if they don't have something, if we could get you a product that's really going to give you the most bang for the buck, the most bang for your buck, in my opinion, it's the best policy on the market for you know, for a guaranteed death benefit. Would you be willing to do like a quick like blood and urine sample? Have someone come by the house, do a quick blood and urine sample. Most people are fine with it. Every once in a while, you get that small percentage of people that are terrified of needles and they don't want to do it, or they don't want to take the time or whatever. So I would say with the people that don't want to take the time, what I have done in the past is, say you get somebody, some little old lady, she has a $20,000 final expense policy. Um, you talk to her, she's healthy. You have to keep in mind with these simplified issue products, whether it's simplified issue term or simplified issue IUL, that's actually the hardest underwriting out there to get approved. In my mind, it kind of goes like this. The hardest underwriting out there is the simplified issue term and IUL. Then after that, you're going to have like the fully underwritten stuff, like the North American term, North American IUL. And then the easiest to get approved for are all those final expense policies that we sign people up for, the $10,000, burial policies and stuff like that. So, but on the top of that scale, the one that's hardest to get approved, what you can do, say I was talking to this little old lady, she has a $20,000 permanent life insurance policy. She wants to leave it to her kids, to pay her burial and have some extra money. And you have that conversation. She is healthy. What you can kind of do to get an instant decision, what I've written a lot of in the past is the Mutual of Omaha IULE. Um, what that does is it's just priced like so much better than a regular final expense policy. So in a lot of cases, the other cool thing about that Mutual of Omaha IULE is they will actually go all the way down as a minimum. They'll go down to $25,000 as a death benefit. Most of these IUL companies, whether it's simplified issue or fully underwritten, they're only going to go down as low as like 50,000 or even like 100,000 in some cases. So I have written many of those IULEs because I've come across so many people, like say this lady has $20,000 of, America or whatever. These people are getting lumped in, even though she's extremely healthy, they're getting lumped into all these people that have like some health conditions or whatever. Maybe this person, these other people had some health conditions and they got approved for this same Americo policy hypothetically, but they had, cancer 10 years ago or some other stuff going on. This lady I'm talking to now, Jackie, keep the same name. She's getting lumped into all those people. So it's like she can take advantage of the fact that she's extremely healthy, qualify for this Mutual of Omaha IULE, and now, just hypothetically, instead of her having this $20,000 policy that she currently have, now I'm getting her say like $50,000 of coverage, for the same price that she's paying now. And then also recently, I think I've tried to write it a couple times and it hasn't like worked out just for various reasons or whatever. But now America also has that IULE policy, which is also instant approval. And again, make sure that people are very healthy. And theirs only goes down to 50,000, whereas the Mutual of Omaha IULE goes down to 25,000. But that America one, the benefit of it is even though it only goes down to 50,000, I feel like their pricing when I've compared it to the Mutual of Omaha IULE is actually slightly less expensive. But getting back to the main question, the reason we did that one for Mikey's client is, they were willing to do the exam. I forgot what the death benefit amount was, but it was a higher amount. And I think they were willing to spend around like $400 a month. So, you could get him that protection builder. And for older people too, I mean, you kind of got to err on the side of caution. I mean, the protection builder, it's not really that much more to guarantee the death benefit. So I'd say like usually, play around with the numbers and the guarantees, but throw it in there and maybe guarantee it till age 90, then you don't even have to worry about like, oh, if like, Armageddon happened and the market plummeted for the next 10 years, is there a potential that this policy might not pay out? And the only reason I say to do that is these people in that scenario, they're not really as worried about the cash value growth. They just want like a permanent life insurance policy. So yeah, we set that up. I think it went through fine, and it got approved. I think has Mikey been paid out on that and everything?
Yep, that one's been paid and approved.
Yeah, and
As oh, sorry, go ahead.
I was just going to say, in that situation, I mean, that was by far, I mean, there's no other policy on the market out there that's going to come even close to what Mikey just did for that woman. I mean, he could have 100 other agents call up and try to steal that away and give them something better, give them something better. It's just not going to happen. I mean, there might be another company that almost has like an apples to apples type comparison, maybe able to offer them something similar, but there's no way that anyone's going to be able to call up and replace that policy because there's something better on the market.
Very good. Monica has the questions that I have no idea about. Can you touch on the pre and post 7702 options and why you choose guideline premium test?
The pre and post 702 options. Honestly, I don't even know what that is.
Well, John is really heavy and big into that, but there's like pre and post 7702, a change with the tax law has to do with how much you can contribute in taxable interest and gains, but it's pretty complicated and apparently it's a part of all these IULs.
Okay.
And we all
Yeah.
never knew. It's a big deal that we don't know, probably.
Yeah.
But I know I took a training that he had with the Shield, oh gosh, a while ago now. Something to do with there's like 3 different ways to illustrate mech, non-mech, and one other way.
Yeah, and I know there's like situations where like if you were gonna drop a big lump sum into this, like
Right.
there's certain scenarios where like you just want it to become a mech like on the front end,
Mhm.
which would make sense. Like, say you have $100,000 and you want to put it in an IUL for whatever reason. And I don't even know the specifics as to why you would want to do that versus just putting it in an annuity.
Sure.
Other than maybe, I mean, it's kind of sometimes you just got to kind of like think about it on your own and be like, why would somebody do that? And I would think maybe you'd want to do that because you just want to. Well, that's the thing is like I think in that situation, even the growth would be taxable. So I don't know.
It's
And that's
something like you can check mark a box. I know it's that way on the F&G app, and I've written a lot of their policies, but for their IUL, so I'm used to the illustration. But you check mark a box, and it allows for a lot more growth options than you ever thought possible, and it's still considered non-mech. So it's
yeah,
like a pre and post tax law change in like 2020, and it's a
yeah.
big deal, and it has to do with contributions and things like that as well. So.
Yeah, I would just say like it's good that we always have they're actually the technical name is internal wholesaler Anthony Holland. Like he's direct to us.
Mhm.
For any like real complex scenarios or questions we don't come across very often, it's good that we always have these people on call, that we can call them up anytime, and they're always like they're always real nice, really helpful, always real, if we do get their answering machine, they're always really good about calling us back too, so we can usually find out that information like pretty quick.
The second question I had was like, do you go into like I always pull up like irs.gov
Mhm.
and do like the compound interest calculator. Like, let's just use a hypothetical. You're contributing $500 a month into this for 25 years. This is
Uh-huh.
what it's going to look like. And at the very end, I go back to it and show them, okay, so now let's take the taxes out. Like, what kind of approach do you use? Because
Yeah,
it can be a tricky thing to compare the two.
yeah, so there's another thing that North American is really big on, and I've only done this one time because I'm not like super good at it, and I can't remember the name of it, but there's another tool that they have. I'm trying to see if it's on here. I don't see it. There's another tool that they have where you can basically, and it sounds like the same thing as or similar to what you're talking about. Like you can put you can put an IUL side by side with like a regular 401k or Roth, and
Right.
it'll kind of like show the difference, with you'll put it in like an assumed return rate for both of them, and then it'll calculate and it'll show you like the difference between the two, just not having to pay those taxes, it's such a big thing because, and that's the other thing you can harp on too is like, most people when you're talking to a client, I think people are always a little bit more skeptical of what the government's gonna do. So I think, you know, and there's another good book that talks about this too. It's not the what is it? It's I forgot the exact name of it, but it's something to do with like retiring and the 0% tax bracket, Um, that one is a really good one that I would take a look at, if you really wanted to get into IUL more. Um, but basically, when you put both of the products side by side, it's just going to show you like not having to pay those taxes versus say, what if in 20 years when the person goes to retire, we're at like a 40% tax bracket or even a 30% tax bracket. I think generally right now, depending on who you are and how much you make, of course, a lot of people are at like a 20%, a 25% tax bracket. I talked to a guy recently. I think the highest tax bracket based on what I saw, I think it was for 2003, was like a 37% tax bracket. And I actually talked to one of my clients who was actually at that 37% tax bracket. And, obviously there's always a lot of stuff going on, in the media and the government. Right now, there's that big tax bill that they're trying to pass right now, which, generally speaking, if you look at it, that's gonna help like everyone out there. If this legislation passes, if this legislation doesn't pass, we're gonna go back to how taxes were before 2017, and that's another thing that book that I just referred to talks about. I mean, the tax legislation of 2017 was regarding taxes, one of the best things that ever happened for our country. I mean, we've been paying historically low taxes ever since 2017. And if, you can get into politics and all this, and if people don't believe me or you're skeptical or whatever, it doesn't say that, yeah, it doesn't just talk about it in this book or whatever, but as long as you're making the same amount of money, go back and look at your taxes, say in like 2017, 2018, 2019 versus what you were paying before, like 2015, 2014, and before that. I guarantee you, if you're comparing apples to apples, you are paying less taxes now since 2017 than you were prior to 2017. And that's what they're trying to do right now is, keep these current tax laws enforced right now and make them even better. Because if these bills don't pass and we go back to how it was before 2017, it's going to be much worse for most of America. And so that's something you always have to keep in mind when you're talking to these people. But if you do ask that question, most people are skeptical. You can ask like, Mr. Customer, in 20, 30 years when you go to retire, do you think taxes are going to be higher or lower than they are now? Most people are going to be like, well, the way things are going, they'll probably be higher than they are now. And that's where you can really harp on that. Well, look, this is showing it right now just at 20 or 25% when you do that side by side comparison. And I wish I remembered what the name of that tool is, because it's really cool and I want to use it more. But it'll just show you like the IUL is gonna blow away a Roth IRA. And then the other factor about that too is, if you think about it, when you start taking money out of either retirement vehicle, whether it's say a 401k or a Roth, you can even compare the Roth in there versus a 401k. Like when you say you had $1 million in a 401k and you take in a given year, you take $100,000 out of your 401k. When you take that money out, that money is just gone, right? Now you're like at 900,000. Of course, if the market goes up, you're still getting gains on that 900,000 that's left over. But what if the market plummets? Well, now you just lost 100,000. Plus you're going to get taxed on that 100,000, say 25, 30% or whatever the tax rate is that time. Now the market goes down. So now your $900,000 is even less than that, versus like a 401k, you're not having to deal, or I'm sorry, versus the IUL. Not only are you not having to deal with that tax aspect of it, so you're not losing 20, 30, whatever percent right off the top of the money that you take in. If you took $100,000 out of your IUL, you're getting all $100,000 of that money. But you're also not having to worry about if the market goes down that year, plus your account value isn't even decreasing by that $100,000 that you took out. You're still at $1 million with a chance for positive arbitrage, the chance to actually make money even off the $100,000 that you just took out of your IUL. So it's like, if you think about it in that respect, it's just, there's no comparison.